sometimes it's fun to break down the sectors and the flows there, and it's all tech, right? You look at sectors this year, tech ETFs are beating every other sector by twofold with $9 billion, right? So this is the depth of flows, and it's not a surprise. Tech's up 12%. It's basically carrying the whole stock market. But there's also the breadth of flows. And so this is a new metric we track that it's simple, right? You look at the percentage of the ETFs in the category that have taken in money, and you're looking at 76% of tech ETFs have taken in cash. Hat tip to Tom Sarafagas and BI for this chart. And this is nothing new. Look, tech has historically been the dominant sector. If you go back historically, it's just done so well. It's got $160 billion in assets, which is by far the biggest, and it's up 500% since the end of the financial crisis. And that's really what is driving those flows and those assets. You can see here, this is since 2008. It's number one. Here's the thing, though. There's a sort of a dark cloud hanging over this, which is there's a huge reclassification coming up at the end of September. And tech's going to lose a bunch of its superstar stocks like Facebook and Google. And guess where they're going? They're going all the way down here to the unloved telecom sector, renamed communications. So, Scarlett, I'm not sure how bullish you can be on the tech sector or tech ETFs, knowing this is just right around the corner.
Although right around the corner means January of next year, there's a lot of time until then to make your trades. Eric Balchunas, thank you so much. Let's bring in Corey Hofstein, CIO of Newfound Research, and Carolina Wilson of Bloomberg News. Corey, tech clearly the driver for U.S. stocks last year, and they continue to build on that momentum this year, even as volatility and headwinds increase. Why is tech still so much in favor?
Well, when you look at tech, it still has incredible breadth in its short, medium-term, and long-term momentum on both a total return and a risk-adjusted basis. So that really does provide a tremendous amount of tailwind to the sector going forward, at least in the short term. And so I think for investors who are looking to make a short-term trade, tech can still be the place to look.
Now, you do sector models. You really rely on history. Is this going to mess up all your models? How big of a pain is this going to be for you and others to recalibrate your whole strategy?
Absolutely. This is a big change. When you look at the new communications sector, it's projected to be about 13% of the S&P 500, third largest sector. So that's going to be a big change. But when it comes to using our models, whether it's momentum, trend, even something like value, you're going to have to reconstitute all your indices and recreate all that historical data so you take into account these changes.
Yeah, a lot of adjustments to make there. Speaking of adjustments, Carolina, the future of smart beta is very much upon us right now. The Inside Smart Beta Conference is taking place in New York this week. You've written about how smart beta may be played out in equities because there's not much left to factorize anymore. Fixed income ETFs, by contrast, will be the next phase because they're just a fraction of the smart beta ETF assets.
Absolutely. I mean, there's a lot of clutter, almost an oversaturation of products in the smart beta equity space. So much so that it's really slowed down product launches in that category. Last year, we had about 100 new smart beta equity funds. This year, the first half, we're seeing about only 20 so far. And that really pushes issuers to try and factorize fixed income. So looking to bonds as the next frontier for smart beta product development. I mean, so much so that it even drives M&A. I was talking to Invesco's PowerShares head, and he was saying that was the main driver behind their acquisition of Guggenheim. They really wanted to secure that fixed income smart beta expertise.
Get that toehold.
Yeah, that's right. And fixed income factors or non-factors, you were telling me you don't really think fixed income is somewhere you want to go right now. You don't recommend it. Why? And where do you recommend people shift into?
Well, I think fixed income is one of those spaces where you can forecast returns with a high degree of accuracy. You can look at the starting yield to worst and get a good idea about where returns are going to be going forward. So for a lot of investors today relying on fixed income to manage their risk, they're foregoing a lot of return in a low yield environment. So what we're talking about with those types of investors is perhaps moving up the risk spectrum, using things like equities, but lower risk equities. So something like low volatility ETFs like USMV or even quality ETFs. My particular take on quality tends to be more in the dividend growth area. You can go very vanilla with an ETF like Noble, or you can use something like QDF or even Wisdom Tree's approach. And I think they're all have merit.
Play it safe. You could also go into value equities as well. But question here, Eric, and I know this is something you debate on Twitter with your friends, is how do you measure value? Is it price to book? Is it something else?
Yeah, and let's expand this with price to book only. Almost every value ETFs use it in some form. A lot of people are saying it's broken. And if that's true, if price to book is antiquated and doesn't work, that means a lot of value ETFs are built on a faulty foundation. What's your take on that? You pick value ETFs. Do you take that into account?
Right, absolutely I do. I'm a big fan of taking a more composite account approach where you look at an ETF that ideally doesn't just use something like price to book, but uses other ways of looking at value, sort of helping you triangulate more on the truth of where value can be found.
All right, I want to ask you about one of your hidden gems, which is CSM. It's a ProShares Large Cap Core Plus. This is kind of a watered down hedge fund strategy. Explain why you like this 130-30 approach.
Yeah, boring name, but sort of an interesting approach at the end of the day. It's one of the very original multi-factor ETFs launched a little over 10 years ago, so it has a live 10-year track record, and it's a bit of a throwback with that 130-30 style approach that was so popular in 2006, 2007. And the idea, quite simply, is to use that 30% of shorting to give you a little more exposure to those securities that you do like. I will say, from an actual construction perspective, it is a little bit confusing. It's a little bit opaque, probably one that people need to do a pretty significant deep dive into.
Corey, if we compare CSM's performance to that of SPY's, like during sharp pullbacks in the market, like let's say 2008 or earlier this year, if you look at the performance of those during those kind of like sharp pullbacks, you really do see them performing kind of equally. I wonder, are you not paying more in management fees for kind of like a sense of comfort that isn't really supported by that historical performance?
Well, I would say it's, again, more of an alpha play than a risk management play. So if you're buying this is more of a return enhancer than a risk reducer. That 130-30 is still going to give you very market-like exposure. The goal is over rolling 3 and 5 year periods to generate some alpha.
And Corey, just to take a real big step back, you're a quant, there's active stock pickers. What's your sales pitch for the quantitative, more mechanical approach than discretionary active?
I think a lot of people make a big deal about quant versus discretionary. My view is most discretionary managers say that they have a systematic, disciplined approach. The reality is most discretionary managers can be broken down into a systematic approach that they then choose to deviate from time to time. And my view is that value of deviating isn't really all it's cracked up to be, that over the long run, being systematic is more valuable.